fact, we get the 3,500 again, but a few days ago, top tick again. So they keep selling it there at that big round number. But all this while, S&P went up. I'm gonna bet you that when the S&P does start down again, and prove, even to the price chart guys, that the recent breakout above the early year highs was false, meaning unsustainable. It was just another new high that didn't go anywhere. Gold will be advancing through the 3,500 and all the way up. In fact, if you look within the gold complex, the monetary metal complex, and look at silver since mid-April, it's gone up. The gold miners, silver miners have gone up, even though gold has just held steady. So this fits with another scenario we have, and that is the asset flows in that area now favor the miners in silver. And therefore, we do think silver will see that zone this year, 60 to 70. It's congested for the last 4 weeks, let's say. 39 has been a level that the ever bears keep selling. Probably because it's in front of a big round number called 40, so, hey, let's risk a dime, and so far they're getting a lot of selling done, but not much price sustainability on the downside. It has spiked down to 37.50. Right now, the SEP silver's trading 38.50, and that was earlier this week or last week at the 37.50. So there's no real sell-off in silver, just a pause, okay? The big issue, I think, is what the stock market asset flows. Now, right now, the stock market is so frothy that I can't believe it. It is really frothy. And in fact, a lot of fundamental analysts out there, and I don't read this stuff in depth, but I know where they're coming from. Leadership is gone. In other words, you're down to very narrow leadership within the market that has driven it to a marginal new high. I say marginal, I mean we're like 4 or 5% above the highs we saw late in 2024, early 2025. Most of the extreme, the buying was in the just getting back there. Okay. Now, if you look at gold, a lot of people assume that if the stock market goes down and you guys are right, it's going to be a bear market, then gold's going to go down too, right? Well, historically, that's not true. There's so many examples. In fact, I'm going to put together a report today on that issue, going back in time.
The U.S. stock market has been climbing, but beneath the surface, cracks are visible. Gains are concentrated in a handful of tech giants, while broader participation fades. This type of narrow leadership has historically signaled fragility, with indexes posting marginal new highs that lack true strength. Technical analysts describe this setup as a broadening top, a dangerous pattern of exaggerated highs and lows that often ends in sharp reversals. If equities stumble, even slightly, confidence may evaporate quickly. Investors already sense the imbalance, shifting funds quietly toward alternative assets like gold, silver, and mining stocks.
If you go back and look at from February, I think it was, I wrote today, February 19th, which is when I think the S&P made its top tick early this year, to April 21st, close to close now, daily close, dropped 16%. Yes, it was more than that intraday highs to intraday lows, but still, it was mid-February to April 21st. Drop hard. What did gold do during that time? Straight up. Okay? It peaked, in fact, on April 21st. There was a peak. Okay? The same day S&P made a low. So, okay, the inversion issue didn't work then. Okay. Since then, the stock market has recovered. Therefore, well, if it, gold should, go down maybe, if you believe that gold is opposite the S&P, which we do. Instead, it held steady. It's been 4 months now where you can draw a line through, upper 3,300s, 3,400. It just goes up and down and up and down. You get the downswings and upswings. In fact, we get the 3,500 again, but a few days ago, top tick again. So they keep selling it there at that big round number. But all this while, S&P went up. I'm going to bet you that when the S&P does start down again and prove, even to the price chart guys, that the recent breakout above the early year highs was false, meaning unsustainable. It was just another new high that didn't go anywhere. gold will be advancing through the 3,500 and all the way up. In fact, if you look within the gold complex, the monetary metal complex, and look at silver since mid-April, it's gone up. The gold miners, silver miners have gone up, even though gold has just held steady. So this fits with another scenario we have, and that is the asset flows in that area now favor the miners in silver. And therefore, we do think silver will see that zone this year, 60 to 70.
Contrary to popular belief, gold does not always decline when stocks fall. History repeatedly shows the opposite. In early 2025, for example, the S&P 500 plunged 16% from February to April, while gold surged to a local peak on the very same day equities bottomed. This demonstrates that during periods of uncertainty, gold often serves as the stabilizing refuge for capital fleeing riskier assets. Even as equities recovered in recent months, gold has held steady, consolidating near the $3,400–$3,500 range. This unusual stability is an important signal. Gold is quietly preparing for its next leg higher.
Actually, from an investment point of view, if you go back, 4, 5, 6 years, you'll find that silver's gained just about as much as gold. It's been more irregular and there was a period there from those mid-2020 price surge where, gold got up over 2,000 and silver got up to 30 area. That gold went sideways during that next several years, 2021, 22, 23, and into early 24. And silver and the gold and silver miners had a staircasing pullback, overlapping, go down, go up, but net on balance, a pullback. So they underperformed. Technically speaking, when we assess that spread relationship between silver and gold and the miners and gold, they've broken out. In other words, they've said to us, that relative underperformance trend is over. They're now outperforming again. And sure enough, look what's happened, over the last couple of months, especially since April. Silver's gone up from, a high in, you go back a year ago, in May 24, we had a surge high at 32.70. And then since gold's gone sideways since April, silver's gained, about 10–15%. And the gold miners have really asserted themselves in a way that surprises most people. Because usually it used to be, if gold has a down day, the miners get beat up pretty good. Now gold could have a down day and they're up. It's surprising to most, not to us. I think that's an indication, especially in the mining sector, that there is money beginning to flow out of the stock market that is it is doubtful money, meaning they doubt the sustainability of what they're seeing on the tape. And therefore they're moving into other assets. And they finally realize that actually the gold miners, they're at a better level now than they've been for 10 years versus the S&P. They've been, in other words, 10 years ago, they're beating the S&P.
While gold has moved sideways, silver and mining equities have surged. Since April, silver has risen over 15%, while leading gold miners like Newmont have soared, outperforming both the metal itself and the broader S&P 500. Even more telling, miners are no longer dragged down by daily fluctuations in gold. Instead, they are rising independently, indicating strong institutional inflows. Technical charts confirm this. Silver miners, ETFs like SIL and GDX have broken out of decade-long basing patterns. These breakouts often precede explosive multi-year rallies. Investors are recognizing that miners, long overlooked, now represent one of the strongest growth plays.
If you just bought and hold the gold miners, nobody knows that. They don't mention that on Fox Business or CNBC about how gold, silver, and the miners are outperforming the S&P 500. And not just for this last year or, several months, but for a protracted period of time. I think that'll continue, and especially when the stock market wobbles back. Now, we come up with numbers every week that if you crack them, you're likely to start back down. I think what's going to upset the public most, and some analysts, is if you do get back below the highs we saw early in the year and indicate, oops, that breakout isn't sustaining. Remember, like the old Cape Canaveral rocket liftoffs, they go up about 200 yards and then they implode back to the launch site. We have also, there was a book written in the 1950s by Edwards and McGee Edwards and MAGE, Edwards and McGee. You can buy it on Amazon. Called Technical Analysis of Stocks. And it is like a 400-page textbook with fine print of chart patterns in price that they developed, explained, defined, and so forth, of topping action and bottoming action that you can apply to stock market investing. But again, we're talking, 1958. Okay, I bought it when I was at E.F. Hutton in 75 at a financial bookstore down near Wall Street. It was sitting in the window there, so I bought it. I still have it. But there's a price pattern in there that very few people ever mention. A lot of people like to define bullish patterns, but there's a price chart pattern that they define called the broadening top. And if you'll put your S&P 500 monthly chart or weekly, go back to 2024, and the same with NASDAQ 100, and put it up on the screen, just price now, you'll see that we made a high in like mid-2024, had a sharp drop into August. It came back in late 2024, early 2025, made a marginal new high above that prior high, and then had to drop into April, a lower low than it occurred in August. So a high, a low, a higher high, a lower low, and now you've kind of made another higher high. So you get 3 higher highs, 2 lower lows. So it's a widening pattern, not a triangle that narrows, but one that widens. And what it's indicative of is a market that's lost its sense of direction. In other words, it's real exuberant one way, and then suddenly it's implosive, and then it's exuberant again. But it's flip-flopping around. It's dying. Okay.
The critical story is money flow. With bond markets struggling and stocks showing exhaustion, institutional capital is looking for a new home. Gold miners, especially large liquid names like Newmont, are attracting this shift. Year to date, Newmont has jumped over 80%, vastly outpacing equity benchmarks. This move isn't fueled by retail enthusiasm, but by large asset managers reallocating capital defensively. The trend suggests a deeper rotation is underway. Once the stock market shows undeniable weakness, this flow is expected to accelerate. In financial history, such rotations often mark the beginning of prolonged bull markets in precious metals and their producers.
If we fall back below the price highs we saw early this year, which is like, 2,200 area in the S&P and so forth and so on, you can look at your charts, then the price guys are going to start to say, well, golly gee, that's, and somebody's going to mention that classic chart pattern to them, the broadening top. And I think that's what we're building in the stock market. And it's a very dangerous pattern because when it's over, it's over. And momentum argues to us by price making new high. Momentum is clearly not. Momentum is, in fact, broken trend. Don't trust the new highs. Okay, if that's the case, then money is going to really start to flow out of the stock market at some point, and I think soon, probably. And where's it going to go? Well, if you do all the performance graphs you want to of this asset category and that, you'll see T-bonds haven't been doing well. They're usually an alternative to the stock market. Not much is doing well, except gold persistently has been doing well. And more money will flow. Look at a chart of Newmont, for example. Pardon me for getting long-winded here. Newmont has both outperformed vastly and underperformed vastly gold price over the years and the mining sector. It's the big blue chip. It's the one that if you're a major asset manager and you're going to buy into the gold stock arena, you're probably going to include Newmont. Why? Because it's the big blue chip. You're not going to go out and buy juniors or something. It has exploded this year. It's up like 85%. What's the S&P up? A 10, 15 from the year with the close of last year. So there's no comparison. Money is flowing into that for some reason. And a lot of that explosion in Newmont has occurred while gold's been going sideways. So think about that. Somebody's buying the gold miners. Why? It's not because they're all frothy about gold over the last 4 months. It's because they're moving money somewhere to somewhere. I think as you break the stock market, that money flow will become massive.
Technically and fundamentally, gold, silver, and miners are poised for a defining move. Silver's path toward the $60-$70 range is increasingly realistic, while mining ETFs like GDX and CL are set for powerful advances after breaking decade-long resistance. The broadening top in equities only adds urgency. Once that fragile structure collapses, safe haven demand could skyrocket. The mining sector's breakout is fresh, meaning the move has only just begun. For investors watching closely, the message is clear. Capital is quietly leaving Wall Street and flowing into hard assets. When the stock market's facade cracks, that flow will become a flood.
Just begun. It's just begun. GDX, for example, or SIL, the silver miner ETF, you go back and look at the 2011 high, look what happened to 2015 collapse, just like gold. Then they built this big, huge, I'm just talking price now. Momentum has already been ahead of this game. Price has built this massive, wide base. For instance, SIL, the silver miner ETF, it's like 10 years wide. Of up, down, in the same range. We've blown through the top of that. We just broke out over the top of that range. And even just the dimension of the price base, forget our momentum work, which has said this all along, the dimension of the price base added to itself, in other words, a swing move, says you're going to go to the old highs again quickly. Whereas GDX is going well up into the 60, 70 zone. It's now in the mid-50s. Upper 50s, excuse me, and SIL's going to explode as well. So, the miners are really technically set, both momentum and now with price action, to launch, and it's fresh. When you look at the price charts of the miners, looking at the big picture again, that basing pattern, it's only just in the last month or two that they've broken through the top of the base. So people that argue, oh, they got to correct, heck, they just broke out of your price base. They've hardly reached any dimensionality that argues overdone, So I think the flow into the miners has only really just begun.